So welcome back, friends. We had the PCE numbers, the Personal Consumption Expenditure Index released today, and it showed a level that was pretty much in line with the expectations. So the markets, the futures which were down, um, went back up and all came back into positive territory. Incidentally, if you watch my video published an hour and a half before the market or before the personal consumption expenditure data was released, clearly predicted that the markets would be up today, would regain ground after the PCE data is released. Now, the big thing that we need to take into account is that uh, quite a lot of the rally has taken place on the basis of expectations that the US Fed will reduce interest rates sooner than later. However, there has been a whole host of CPE data, the Consumer Price Index CPI and the PPI data, which seems to indicate that the inflation is here to stay for a longer term, and that the markets are much hotter. The inflation is not yet under control and is here to stay and not a transient in nature. Therefore, there is expectation that the US Fed would continue to keep the interest rates at a higher level for much longer, and expectations, Fed futures delaying the expectations of a Fed cut into late summer and beyond. The Bank of Japan and the Swiss National Bank have emerged as the two major central banks which are most likely to change course, however, in the next 2 months, but in very different directions. The US Federal Reserve is now expected to cut for the first time in June, with markets narrowly pricing a 25 basis points reduction to take the Fed funds target rate to a range of 5 to 5.25%, according to CME Group's FedWatch tool. Minutes from the Fed's January meeting showed that officials were wary of cutting interest rates too quickly, while expressing cautious optimism about the general downward trend on inflation. The European Central Bank is also expected to start cutting in June, with Eurozone inflation easing to 2.8% in January, while economic growth remains stagnant across much of the European bloc. The Bank of England is now expected to be among the last to begin unwinding its tight monetary policy, with a slim majority of economists projecting a first rate cut in August. And we have Goldman Sachs last week pushing back its projections for rate cut from May to June. So now this is where the problem lies. You keep pushing back and back and back, and there's a point of time you may realize that there's nothing which is forthcoming, and you never know which point of time Fed will start cutting, and this can lead to great amount of consternation and can bring down the markets, because if the rate cuts are not coming, interest rates are higher for longer, then the effects of it, which will begin to feed to the system, and you may start seeing more and more inflation being stronger than anticipated, being more rigid, being more difficult to tame, and that in effect will lead to a vicious cycle. So I believe the next few months are very crucial, and if my analysis is correct, interest rates are going to be here for longer, and this is going to disturb the equation in the stock markets and lead to a nice correction. It could be one of the important reasons. Swiss headline inflation has fallen from 1.7% in December to 1.3% in January, well below the consensus forecast, while the core inflation has dropped from 1.5% to 1.2%. Now, the steep decline meant that inflation looks sure to undershoot the SNB or the Swiss National Bank's Q1 forecast of 1.8%. Along with the fall in core inflation, we think that this will encourage policymakers at the SNB to cut the policy rate from 1.75% to 1.50% at their next meeting in March. Yet the jury is still out ahead of the March 21 meeting, and economists at UBS still believe that SNB will start cutting rates in June, followed by two more rate cuts in September and December for an eventual terminal rate of 1%. So, with the January inflation downside surprise, SNB forecast looks too high, and the probability of a policy rate cut on 21 March has increased. So, to cut rates, one could believe that the end point of the SNB's inflation forecast would need to decline below 1.5 percentage from current 1.6 percentage, and the forecast path would have to become downward sloping. While most of the central banks are looking at loosening monetary policy after more than 2 years of aggressive tightening to combat rampant inflation, the question for the Bank of Japan is just the opposite. And Bank of Japan has everything it needs to finally do away with its negative interest rate regime and the yield curve control policies. The BOJ's short-term deposit rate has been set at minus 0.1 percentage since January 2016, as policymakers looked to stimulate the economy out of a prolonged stagnation. A rate hike would be Japan's first in 16 years. So that's going to be another policy change, just like Swiss National Bank. On the reduction side, this could be on the increase side, the higher side. Japan's core inflation rate, which excludes food and energy, fell to 2% year on year in January after a third monthly increase, surprising slightly on the upside and suggesting that a sustainable return to ultra-low inflation may not be on the cards as yet. If inflation is going to settle around 2% rather than fall on the way back to the 10-year average, which is just over 1%, there is no reason to delay the demise of negative interest rates and the yield curve control policies, is what we imagine. A significant majority of analysts, of course, expect the BOJ to end its 8-year stretch of negative interest rates in April. So here we are just a few months away from major turn in policies of central banks across the world. Central Bank last July, BOJ introduced flexibility to its YCC policy, a long-term measure in which it targets a particular interest rate and subsequently buys and sells bonds accordingly to keep the yield on government bonds within that chosen target range. The BOJ has been reluctant to tame above target inflation by ending its negative interest rate policy due to the fear of knocking Japan's already subdued economy further, of course. Yet, maintaining a loose monetary policy is markedly weakening the yen, contributing to inflation. Inflation about the 2% target for close to 2 years, as it is in the case in Japan, would have spurred most Western central banks into a tightening cycle, but the BOJ is moving very, very cautiously. Memories of tenacious deflation are still fresh, and consumption is brittle given Japan's mature population. Average age is 49 years old versus 39 in the United States, 29 in India. Hiking rates too quickly could risk crashing the economy. However, the weak yen has provided a boon for exporters and a headache for importers and is fueling inflation in Japan. The market pricing for a 10 basis points hike by June and 25 basis points by the year end is cautious enough not to puncture the economy and looks to be very much on the anvil. Friends, so here we see various central bank movements expected shortly, but I believe there could be some delay in all this, in the Swiss National Bank's movement and the Bank of Japan movements and all this, and more importantly, the US Federal Reserve could act a little later than what is being anticipated. All this can come and can derail the expectations of investors and economists, and which can add as a negative impact on stock markets. So this is another risk factor in addition to the ocean of bubbles I see in various asset classes across the world. The delay in hike of interest rates can come as a secondary factor to come and puncture the world economy, the expectations of economists and investors in the stock markets, and can come as a major factor which derails the stock markets. And this is going to happen, I believe, very soon. You may begin to factor in that these expectations not being met is going to come and hit hard and hit the investors hard, and sooner than most people anticipate, because there has this buildup of expectations on interest rates has been going on for a very long time, and pushing um, constantly out into the future is not going to help. So, as more and more inflation data comes, which turns out to be uh, more robust, you will find that chances of Federal Reserve reducing interest rates is going to diminish uh, in the very, very near future, which may come and rattle stock markets worldwide. To get to know more, please do join our Prime or Prime Plus Telegram groups, which are addressed to forecasting when this impact, negative impact, can come, and when the markets can get rattled the most. What is the time duration? But I can tell you it's very much on the cards and it's happening sooner than you anticipate. Happy investing. Have a great weekend. Take care. Bye bye.